Your next 10 years will move faster than your last 10. Income will change, industries will shift, technology will replace roles, and everyday costs across the United States will keep evolving. The people who feel stable in 2036 will be the ones who design their structure in 2026. This is about building a financial system that works quietly in the background while your career, family, and skills grow in the front. Over the next few minutes, you will see how to plan for the next decade using clear steps that real American households are already applying. Start with clarity on income direction. Over the last decade in the U.S., wage growth has moved unevenly across industries. Healthcare, logistics, skilled trades, data roles, and specialized technical services have expanded steadily. Some office-based roles have been reshaped by automation and remote systems. When planning for the next decade, your first focus is not saving more dollars randomly. Your first focus is strengthening income durability. Ask yourself whether your current role is gaining demand or losing demand nationally. Look at Bureau of Labor Statistics projections. Study which certifications or skills increase pay bands in your field. A nurse who adds a specialty certification increases bargaining power. A technician who learns advanced diagnostics raises value per hour. A warehouse supervisor who understands data systems improves promotion chances. Income strength drives every other part of financial stability. Once income direction is clear, build a 10-year earning map. Project conservative annual growth based on realistic industry data. Avoid fantasy jumps. If your field historically grows 3 to 5% per year in wages, use that range. Add expected promotions only if they align with documented pathways in your industry. This creates a grounded income forecast. With that forecast, design spending levels that grow slower than income. Many American households increase expenses immediately after every raise. The stronger approach is to freeze lifestyle expansion for at least 12 months after each income increase. This builds structural surplus that compounds over time. Next comes liquidity discipline. Across the United States, household volatility often appears through job transitions, medical bills, relocation costs, or family support needs. A dedicated liquidity reserve protects decision-making power. This reserve should cover essential living expenses for several months based on your actual fixed costs. Calculate housing, utilities, food, transportation, healthcare out-of-pocket expenses, and basic obligations. Keep this reserve in a stable, accessible account that prioritizes safety over growth. This is the shield that protects long-term planning. After liquidity, focus on ownership structures that align with long-term economic expansion. Over the past century, broad American business growth has been driven by productive companies reinvesting profits and expanding operations. Participation in diversified public companies through compliant investment vehicles allows households to align with that growth. Study the structure of broad U.S. equity index funds that hold large segments of publicly traded American companies. Review expense ratios, underlying holdings, and historical volatility ranges. Avoid chasing short-term performance trends. Build gradual exposure aligned with your risk capacity and time horizon. Over a 10-year window, disciplined contributions smooth market cycles. Housing strategy also shapes the next decade. In many metropolitan areas, housing supply constraints have supported long-term price resilience. Analyze your local market using real transaction data rather than headlines. Compare renting versus ownership over a 10-year horizon, including property taxes, maintenance, and mobility flexibility. Ownership builds equity stability when purchased at sustainable income ratios. Renting provides mobility and lower upfront risk. The decision should align with career stability and geographic plans. Healthcare costs require structured planning as well. Out-of-pocket expenses have risen in many employer plans. Budget for deductibles and routine care based on your actual plan design. Review coverage annually during enrollment periods. Health spending shocks often disrupt long-term plans when unaccounted for. A simple annual health budget review reduces uncertainty. Technology transformation will shape the next decade heavily. Artificial intelligence, automation, and digital platforms continue reshaping labor demand. Allocate time and money each year towards skill reinforcement. Even modest annual training investments create compounding career resilience. Many U.S. employers reimburse certification programs or continuing education. Use those programs strategically. Tax awareness also matters. Understand your federal tax bracket, state obligations if applicable, and capital gain treatment on investments. Structure contributions and withdrawals in ways that align with long-term efficiency. Keep organized documentation. Use reputable tax software or licensed professionals when complexity increases. Another pillar is expense tracking with purpose. Track spending categories quarterly. Identify patterns in housing, food, transportation, subscriptions, and discretionary purchases. The goal is awareness, not restriction. When income rises, maintain fixed expense ratios stable. Let surplus grow automatically toward investment and skill development. Family planning must integrate into financial structure. Education costs, childcare, elder support, and relocation needs should appear in your 10-year projection. Build scenario outlines for at least 2 possible life changes. This reduces emotional decision-making later. Finally, create an annual review ritual. Once per year, review income growth, net worth progression, liquidity levels, skill upgrades, and investment allocation. Adjust gradually. Over 10 years, small structured adjustments outperform reactive decisions. The next decade rewards clarity, discipline, skill growth, diversified ownership, liquidity strength, and realistic projections. You now have the framework. In Part 2, we will build the advanced structure that protects and multiplies this foundation across economic shifts, market volatility, and changing personal priorities. The foundation is built. Now we expand it into a decade-long operating system that remains stable through economic cycles. The next 10 years in the United States will likely include expansions, slowdowns, market volatility, policy changes, and technological acceleration. Planning must account for movement rather than expecting smooth conditions. Begin with income layering. Relying on a single paycheck concentrates risk. Across the U.S., professionals increasingly build secondary skill-based income streams aligned with their expertise. A software developer may consult part-time. A nurse may teach certification courses. A skilled tradesperson may handle small independent contracts. The goal is alignment with existing capability rather than random side activities. Income layering increases resilience and creates optionality if primary employment shifts. Next, strengthen cash flow control systems. Many high earners still experience financial pressure due to unstructured spending growth. Use automated transfers to direct a fixed percentage of each paycheck toward investment and reserves before discretionary spending occurs. Automation removes emotional friction. Increase the percentage gradually when income rises. Investment discipline over the next decade requires emotional control. U.S. markets move in cycles influenced by earnings growth, monetary policy, and global conditions. Historical data shows that long-term participation with consistent contributions outperforms reactive timing attempts for most households. Study volatility ranges of diversified U.S. equity exposure. Prepare mentally for temporary declines without altering long-term allocation, unless life circumstances change. Diversification over the next decade should spread your exposure across different types of productive assets that behave differently in various economic environments. Public equities provide participation in long-term business expansion across the United States. Cash equivalents and capital preservation vehicles provide stability during market swings and protect short-term needs. Real estate ownership offers tangible asset exposure when supported by strong local demand and sustainable income ratios. Allocate based on your age, income durability, liquidity strength, and emotional tolerance for market movement, then review the structure annually to maintain discipline as conditions evolve. Risk management requires structured thinking. Review workplace benefits annually. Understand disability coverage, health plan design, and employer-sponsored programs. Confirm beneficiary designations remain accurate after life changes. Organized documentation reduces confusion during unexpected events. Inflation awareness is critical over a 10-year horizon. Prices in housing, food, healthcare, and education historically trend upward over long periods. Planning should assume moderate annual inflation when projecting future expenses. This ensures savings and investment targets remain realistic. Technology investments inside your personal life also matter. Secure digital financial accounts with strong authentication. Monitor credit reports annually for identity accuracy. Use reputable financial institutions with strong regulatory oversight. Cybersecurity failures can disrupt financial progress quickly. Geographic flexibility plays a growing role in financial planning. Remote work has allowed some Americans to relocate to lower-cost regions while maintaining similar income levels. Analyze cost of living differences carefully before relocating. Consider tax differences, housing markets, healthcare access, and career networking opportunities. Education funding for children requires early projection. Tuition costs across public and private universities have risen over decades. Estimate future costs conservatively. Dedicated education investment vehicles may offer tax advantages. Contributions over many years reduce pressure later. Estate organization is another overlooked element. Draft basic estate documents, including a will and healthcare directive according to state law. Maintain updated asset lists and account access instructions in secure storage. This protects family stability. Behavioral discipline remains the invisible driver. Market headlines, social media investment trends, and speculative enthusiasm can distract from long-term strategy. Build a written investment policy statement for yourself, outlining allocation targets, contribution schedule, rebalancing rules, and risk tolerance. This written document reduces impulsive shifts. Career capital over 10 years may produce greater returns than investment gains. Seek leadership skills, communication ability, and technical specialization. Promotions often follow responsibility expansion and measurable results. Document achievements. Request performance feedback regularly. Income growth tied to value creation compounds faster than passive growth alone. Healthcare planning extends beyond budgeting. Maintain preventive care routines to reduce long-term costs and preserve earning capacity. Physical health and financial health reinforce each other. Community and professional networks influence opportunity flow. Attend industry conferences, join professional associations, maintain LinkedIn presence with updated achievements. Many higher-paying roles circulate within networks before public listings. Entrepreneurial consideration may fit some individuals over the next decade. Starting a small business requires capital discipline, market validation, and regulatory compliance. Research local demand carefully. Build cash reserves before launching. Maintain personal liquidity separate from business funds. Tax efficiency should evolve as income grows. Review withholding accuracy annually. Harvest tax losses strategically when appropriate within investment accounts. Consult licensed professionals when income complexity increases through business ownership or multi-state activity. Long-term asset protection includes understanding legal structures. Limited liability entities may shield personal assets in business contexts when structured properly. Seek legal counsel before forming entities. Philanthropic planning can integrate with tax efficiency and personal values. Donor-advised funds allow structured charitable contributions over time while optimizing tax timing. Align giving with long-term financial capacity. Long-term financial independence over the next decade requires forward projection of future living costs and income flexibility. Estimate the level of annual cash flow you would need to maintain stability if active work slows down or income patterns shift later in life, adjusting those projections for inflation. Build asset targets using conservative growth assumptions so expectations remain realistic. Increase ownership contributions steadily as earnings expand, allowing long-term stability to strengthen quietly in the background while your career continues to develop. Market corrections over the next decade are certain to occur at some point. Prepare psychologically today. Temporary declines are part of long-term equity participation. Liquidity reserves prevent forced selling during downturns. Real estate evaluation should include property tax trends, zoning developments, infrastructure projects, and demographic migration patterns. Population growth supports housing demand. Declining population areas may experience slower appreciation. Monitor federal policy developments affecting taxation, healthcare, and investment regulation. Policy shifts influence planning decisions. Stay informed through reputable financial publications rather than social media commentary. Debt management supports long-term freedom. Prioritize eliminating high-cost obligations. Maintain manageable debt-to-income ratios when purchasing property or financing education. Structured repayment plans reduce stress. Marriage and partnership require transparent financial communication. Align goals, spending habits, and investment philosophy early. Joint planning reduces conflict and strengthens compounding effects. Document storage systems should include encrypted digital backups and secure physical copies of critical records. Organization saves time during emergencies. Review your 10-year plan annually. Adjust projections for income changes, family growth, market returns, and economic conditions. Incremental adaptation outperforms dramatic shifts. By 2036, the Americans who feel confident will be those who built layered income, protected liquidity, diversified ownership, strengthened skills, managed risk thoughtfully, and reviewed progress consistently. Financial planning for the next decade is a living structure. Each disciplined year strengthens the next. The next 10 years will pass regardless. The question is whether they pass with structure or without it.